Hi, welcome to the monthly portfolio update. As usual, I hope you'll find this information useful, but disclaimer, please note that this is not investing advice. It's just my portfolio as it stands on Thursday, June 1st, and it can change at any time without previous notification. Following an investment strategy without doing the work yourself is almost guaranteed to result in losses. So, please be careful since it's your responsibility to do your own research before investing. This month, I continued my dollar cost averaging strategy for buying stocks, usually those entries on my watch list or portfolio that are currently trading at a significant discount to my purchase average. So, in May, I added to my Tesla and UiPath positions and also 7 Romanian companies, Aquila, BRD, DN Agrar, MedLife, One and Romgaz. Plus, I added a new company to my watch list, a purchase under $100, respectively Transport Trade Services, which is a company that transports cargo on rivers, mainly the Danube, and has experienced a boom due to the war in Ukraine. I also continued to trim down my Transgaz and sold a total of about 25% of my position to a pretty good profit of about 27%, but actually made a mistake, which inspired today's topic of learning from theory, practice, and of course, from our own mistakes. You might remember that last month I sold about 20% of the position and waited for the 16-to-1 split that came on May 3rd and sold all of my remaining shares until I received the new ones at a high premium. However, there was a technical issue that I didn't foresee. The fact that Romania changed its tax code this year, and if you own an asset for more than 1 year, you pay 1% tax. But if you own it for less, it's 3%, as well as being unable to deduct losses. That being said, the new stock that I got after the split are now considered less than a year old, which will triple my tax bill. Now, this is not the biggest problem ever, but it is an unforced technical error. I am not super upset about it since I was never planning to sell 100% of my shares, and selling 25% enabled me to re-up my cash position to a very comfortable level, so the main goal was achieved. However, to be honest, I would have sold more, maybe over 50 or even 75%. Now, instead, I will keep it and get the 4% dividend scheduled for July 19 and wait to see if Romanian natural gas production will increase in the next 1 to 2 years due to Europe importing less from Russia, since we actually discovered significant reserve in the Black Sea on 2 major deposits. The decision was made easier by the fact that after the split, Transgaz is now trading lower than my purchase price, and it makes no sense for me to sell at this point. Now, this is not good news by any stretch of the imagination, but it makes it easier cognitively to cope with it. I am usually fine with making mistakes of analysis, but these execution mistakes should not be tolerated, and in all honesty, they don't come too often, and so far I never repeated one that I already did, which I guess this is the glass half full approach. I made maybe 3 such mistakes in the last 5 years, and today I decided to share with them. The first one was already discussed, losing the tax benefits after the 16-to-1 split at Transgaz. Next, I will share one that happened 2 years ago and relates to the first time I traded bonds. When I first started buying tradable bonds, I was expecting the price of a bond to trade the same way as a stock. Basically, there is an intrinsic price, and in the case of bonds, if you wait until the end of the period, you get the agreed coupon or yield and the amount you invested. And if someone wants to trade it before then, the free market enters into effect, and it depends on how bad they want to get out or in, and they can get a 1, 5, 10% discount or premium. Makes sense, right? Well, that is not really the case. The way bonds are traded is slightly different, with what's known as the clean price, which is the price that the seller wants. However, when you buy the bond, you actually pay what's called the dirty price, which is the price that the seller wants plus the yield that it accumulated so far. For example, let's make it easy and say that a 1-year bond costs 100 RON and yields 9% a year. Now, this is what happened with my Restart Energy 1 bonds that I bought. For whatever reason, after 3 months, the owner wants to sell quickly, so they decide to do a 5% discount. But now, the new price the buyer will pay is the clean price, which is 95, 100 minus 5%, plus the yield accrued so far for the year, which at 3 months is a quarter of the yearly yield, which is 2.25%. So the final price that is actually paid is 97.25. This is not a problem, it's just the way things work, but there was a bug in my broker's interface that showed only the clean price, 95, and not the actual buying price, 97.25. Now, the amounts were so small that it didn't really matter, but it was a surprise for me because I actually bought quite a few treasury bonds before, but they were not tradable, so not subject to the clean dirty price rule. The most important thing is that I learned the lesson when I later bought way more tradable Romanian treasury bonds, and I knew what to expect. And for the last mistake, which chronologically was actually the first one, was in 2018, the Romanian lawmakers dropped some unfavorable and unexpected legislation on the energy companies sometime around Christmas, which allowed me to buy at a significant discount Nuclearelectrica, the nuclear energy company that I still own today, and then sold the position 6 months later at a significant profit. However, when the decision was made that I wanted to mark the profit, I just dumped all my shares, which, to be honest, were not that many. However, the price instantly crashed by around 2%. Again, not a big hit, but this is how I learned to test the waters first, and getting out of the position can take months, depending on the size. Almost always, the decision to sell price, the price you say, yeah, that's good enough, let's sell now, is actually smaller than the final actual profit that you get. Why is that? Well, you get hit with some of the following: broker fees, taxes, you can face liquidity issues, and or the market can move against you. These last two can be both at the same time or complementary. If you sell too fast, you get into liquidity issues like I did, but if you sell too slow, the market might move against you. As a side comment, I now appreciate more the big hedge fund managers which have to sell significant positions, since the price they actually are able to capture is significantly lower than the price they made the decision to sell at, simply due to the volume they sell. They inevitably will move the market against them. Maybe this is why most big hedge funds underperform the indexes over the long term. But let's not feel too bad for them, since if you are a Berkshire or Oaktree Capital, you are also able to negotiate an over-the-counter discounted deal just because of your sheer size with the likes of Bank of America or Internazionale Milano when they need cash badly. Anyways, these were the 3 recent technical mistakes. Again, I'm not against mistakes since they are a fact of life in investing, and even the best investors of all time are only right a little bit more than half of the time. However, since these are not analysis mistakes but execution/technical mistakes, they are for me like a double foul in tennis or an unprovoked mistakes, and for some reason they hurt more, even though the actual impact on the portfolio is smaller than, let's say, an Alibaba stagnating at a loss for the past 2 years or so. However, there is also good news, since this helped me to put systems in place that allow me to minimize the impact of a mistake. And more importantly, no mistake should wipe you out, technical or fundamental or otherwise. Secondly, you have to have the mentality of lifelong learning from mistakes. Always learn from them and don't make the same mistake twice. For me, this rule seems to be one every 2 years or so, and they are quite different in nature, which I guess is good. And lastly, be humble in investing as well as other areas of your life. The Dunning-Kruger effect is a cognitive bias where people with low ability or expertise tend to overestimate their ability or knowledge in a specific area due to a lack of self-awareness. It is based on a 1999 paper by Cornell University psychologists David Dunning and Justin Kruger, and basically the main point is that sometimes you just don't know what you don't know. Please let me know in the comments what mistake you've made, if any, and if you enjoyed the video so far, please don't forget to like and subscribe. It really costs you nothing and helps the channel a lot. And it will help me get through the pain of this month's mistake quicker. Wink wink. Anyways, now let's get back to our regular programming. This is my portfolio allocation as of June 1st, 2023. Overall, the actively managed portfolio went down quite a bit, but is still slightly positive with a 0.05%, and the overall portfolio is doing slightly better for the year, being up 0.75%. This represents a decrease since last month, mainly reflected in the price drop of Transgaz, which is still currently at 11% of the portfolio, as well as a steep drop in my two Chinese equities in the last week, Alibaba and Prosus, which is a proxy for Tencent. The pyramid is as follows. The cash position is now very stable with significant cash flow coming in the next couple of months. One thing I forgot to mention is that I also received a very small dividend from One United Properties, the real estate company from Bucharest, that is on my watch list. To give you a sense of the size, it was so small that I almost forgot about it and didn't really change any of the percentages. You can see the significant decrease in value stocks due mostly to the Transgaz sale and post-split price drop. And a 1% increase in cash, which is smaller than expected since this month I had to pay my taxes, and that took a relatively significant chunk of money, as well as my dollar cost averaging program was more well funded than previous months by maybe 50%. In the end, I leave you with this thought. Before making this video, I was wondering if I should talk about it since it makes me look not so great. But believing that investing is always win after win after win is simply not true, and also it was a bit of free therapy for me. Anyways, I hope you enjoyed it and see you next month. Bye bye.